Hello everyone, this video lecture series on class 12th CBSE Macroeconomics is brought to you by the 7th Monk. In this video lecture series, we will be covering all the chapters that are there in CBSE Macroeconomics syllabus. So first of all, let's have a look at the syllabus of CBSE Economics class 12th. There are three parts in it. Part A, that is Introductory Macroeconomics. Part B is Indian Economic Development and Part C is Project Work. Both Part A and Part B are of 40 marks each and Part C is of 20 marks. We will be covering all these three parts in different video series. This video series is concerned with Part A only, which is of 40 marks. So here we will be covering all the 5 units of Introductory Macroeconomics. Basically in this unit, we will deal with the first chapter, that is National Income and Related Aggregates, which is of 10 marks. So it is very much important from exam perspective as well as for building a strong base in macroeconomics and also for understanding our country very well. So let's see what we have to study there in this chapter. First of all, we will do what is macroeconomics, then some basic concepts in macroeconomics like consumption goods, capital goods, final goods, intermediate goods, stock and flow, gross investment and depreciation, etc. After that, we will do circular flow of income in two-sector model. Now there are 3-sector and 4-sector model as well, but as per your syllabus, we are restricted to 2-sector model only. Then we will do methods of calculating national income. There are 3 methods for it: product method, expenditure method and income method. After that, we will do aggregates related to national income like GNP, NNP, GDP, NDP, etc. And then we will do GDP and welfare. So basically in this video, we will be doing all the basic concepts, that is the definition of macroeconomics and the basic concepts of macroeconomics and the circular flow of income. All the technical portion like calculation of national income and aggregates related to it as well as GDP and welfare will be covered in the next video, right? So let's get started with the first concept of this series, that is macroeconomics. So last year you studied about microeconomics. Microeconomics used to deal with individual, right? Now in macroeconomics we will study the aggregate of the economy. If micro is a tree, then macro is the entire forest, because here we study about the whole economy. So macroeconomics deal with aggregate of the economy. That's why here we study things like national income, total employment, general price level, etc. Okay, the main objective is to study the problems, policies and principles relating to full employment of resources. If you remember, in microeconomics, for studying anything, any law or principle, we used to formulate some assumptions on its base. So that was called partial equilibrium analysis. In the same way, for studying macroeconomics, there is always general economic analysis. Now what is this? General economic analysis means there is mutual interdependence of different economic variables. Now suppose if the whole society starts saving, then it will reduce consumption, which will reduce demand, which in turn will reduce income. So here we can find that one factor is dependent upon another factor. That's why it is called general economic analysis. That is, there is mutual interdependence of different economic variables, right? Now the major instruments or variable of macroeconomics are aggregate demand and aggregate supply. In microeconomics, they used to be demand and supply, but since this is about whole economy, that's why we will take aggregate demand and aggregate supply as its instruments. There are several names given to macroeconomics like income theory, employment theory, etc. Now why such names are given? You will get to know about it by looking at the subject matter that macroeconomics deals with. Macroeconomics is also called theory of economic development. Now why so? You will have a look at it. So the next basic concept with which we have to deal with is about consumption goods and capital goods. So what are these? So basically, if you buy a juicer for making juice at your house, then that good will be a consumption good. If you will use the same juicer at a juice stall, then that will become a capital good. Okay, so whether a good is a consumption good or a capital good depends upon its final use, whether you are using it for further production or whether you are using it just for satisfying your wants. If you are using it for satisfying your wants only, then that would be a consumption good. Or if you will be using it for further production, that is for earning money, then that will become a capital good. So basically, consumption goods are those goods which are directly used for satisfying human wants. For example, a fan in a house. And capital goods are those goods which help in further production. They are the fixed assets of producers and they repeatedly help in production. For example, a machine in a firm, right? Now, always remember that higher production of consumption goods lead to higher level of welfare of the people as it raises their quality of life, and higher production of capital goods lead to higher productive capacity in the economy, and it is good for future growth. And the expenditure on consumption goods is consumption expenditure, and the expenditure on capital goods is called investment expenditure. So I guess that this is clear to you. Now, always remember that consumption goods are also called consumer goods sometimes, right? So don't get confused between that. Now, similarly, if you're buying a machine for your own purpose, then that will be a consumption good. And if it is for establishing a firm, then that will become a capital good. Here you can see in this picture, I have shown various types of good. So, which are either consumer or capital good. So here you can see capital goods are bought for producing other goods. For example, a tractor, a harvester, all these goods are used for producing other good, right? Now, consumer goods are bought for personal use and not for producing other good. For example, shirt, etc., right? Now, the next concept that we have to deal with is final and intermediate goods. So basically, final goods are those goods which are reaching to the consumer that we are using, okay? And intermediate goods are kind of raw materials that are used for producing that final good which is reaching us, okay? For example, here in this case, you can see that cloth is a final good because consumers are buying cloth, and cotton as well as thread are intermediate goods. Why they are intermediate goods? Because they are used as raw material in order to produce the final good, that is cloth, which consumer is buying. Is that clear? Consumer will not buy cotton because he cannot wear cotton directly, right? Consumer will not also buy thread because he will not just wrap thread on his or her body. He will just buy cloth because from that cloth only he can design the shirt he or she likes, okay, for himself or herself. So that's why the good which is reaching to us, which we are buying, is consumer good, and the goods which are used as raw material are what? Are intermediate goods. So here you can see that this bold boundary is production boundary. So all those goods which are inside this production boundary like cotton and thread are intermediate goods, and the thing which is crossing this bold line, that is this production boundary, that is cloth, is consumer good, okay? Or you can say it is final good because consumer is buying this good. Is that clear? And these goods which are inside boundary line of production are simply intermediate goods. Now see, the cotton is of rupees 2000 and thread is of rupees 3000. So the thread maker is including the value of cotton in it, and as well as the value he is adding to it. So 1000 is a value that he is adding to it. And when producer C is buying thread for rupees 3000, then he is including the value of thread as well as the value addition that he is making. So in the final good, that is in the value of cloth, the value of cotton as well as value of thread is already included. So we need not to include them separately in national income. That's why only final goods are included while calculating national income. The value of intermediate goods are not included, because if we will add the value of intermediate goods as well, then it will lead to the problem of double counting. So in order to avoid the value of double counting, we only include the value of final goods while calculating national income. Is that very clear? Now let's see the clear-cut difference between final goods and intermediate goods. Alright, so final goods are those goods which remain within the boundary line of production and they are not ready for use by their final users, okay? And final goods are the goods which are outside the boundary line of production and they are ready for final use. Intermediate goods are used as raw materials, but final goods are not used as raw materials. And intermediate goods are either for resale or further production, but final goods are ready for consumption or they are used for investment. Intermediate goods may be resold by the firm for profit during the accounting year, but final goods are not resold. And in intermediate goods, value is yet to be added, but in final goods, value is not to be added. Expenditure on intermediate good is always called intermediate consumption or intermediate cost, and the expenditure on final goods is called final expenditure. And always remember that intermediate goods are not included while estimating national income, but final goods are included while estimating national income. Why intermediate goods are not included? Because they will lead to the problem of double counting. Now, here also, whether a good is intermediate good or final good depends upon its final use. For example, if I am buying bread for self-consumption, then that will be a final good. But if I am using those breads for making sandwich and then selling it to consumers, then that will become an intermediate good, right? Now, the next concept that we have to deal with is flow concept. So flow is that quantity of economic variable which is measured during a period of time that is between 2 points of time. Because it is measured between 2 points of time, right? So many things can change. That's why it is a dynamic concept and it has got time dimensions. For example, national income is measured between 2 points of time, that is between 1st of April to 31st of March. So that's why it is a flow concept. Similarly, exports and imports are also measured over a period of time. So they are also flow concepts. Now, stock is just opposite to flow. Stock is that quantity of an economic variable which is measured at a particular point of time, right? So that's why it is a static concept, because at a particular point of time, nothing can change. If I am saying what is the money flow, money supply in the economy on 31st March at 12 a.m., then at that particular point of time, it would be static. It can't change in in some seconds, right? That's why it does not have time dimension, and examples are money supply, national wealth, etc. The next concept that we have to do is investment. Investment is also called capital formation. Now, what is this? Suppose I am a firm owner and I buy some machines so that the productivity of laborers can increase. So, what it is called? It is called investment, because I am doing some act by which the returns in the future can increase. So, investment means addition made to the existing stock of capital during the year. It increases the productive capacity of the producers. People often use this term in general conversations as well. Okay, they say that I have done some sort of investment. So investment basically is anything which will be yielding higher returns in future, okay, which will be becoming a source of profit for future. Okay, if you buy some rental buildings, then that will also be an example of investment, because then also there is an addition to the existing stock of capital, and that will increase the productive capacity of producer, that will help you to increase money, increase profits in future. Now, investment can be of two types. It can either be gross or it can be net, depending upon whether you are taking total or the actual amount. See, when I am buying a new machine, then my firm already has some machine which are not working properly. So if I am including the value of those machines as well, which are working only partially, as well as the value of new machines, then that would be gross investment. So gross investment is a total addition made to the capital stock of economy in a given period of time, right? And net investment is the actual addition, that is, I am removing the value of those depreciated machines which are not working properly. I am only including the value of those new machines which are in a proper condition to work. So that would be net investment. So net investment is nothing but the actual addition made to the capital stock of the economy. Now it is very simple. Whenever you have to go from net to gross, just add depreciation, and whenever you have to come from gross to net, then always subtract depreciation. That is the only difference. Okay, gross contain depreciation, but net does not contain the depreciated value. So this statement highlights it very succinctly, that net statement is equal to gross investment minus depreciation. If you will remove depreciation from gross investment, then the remaining will be net investment, right? Now, what is this depreciation? See, if you buy a car today, then after 10 years, its value will be reduced. Suppose you buy a car for rupees 10 lakh, after 10 years, its value will be merely 1 lakh or 2 lakh. Now, why so? Because you are using it over a period of time. There is some sort of wear and tear in it. Okay, there is some sort of obsolete technology, and technology has also changed. So because of those things, those factors, the value of those fixed assets have fallen down. So that fallen value of fixed assets is called depreciation. See, you can see if you buy an iPhone, okay, then after 3 or 4 months its value get reduced by a very huge amount. Okay, for example, if it is of 1 lakh today, then on the day of its release, then it would be about 60,000 after 2 to 3 months, right? So why this happened? This happens because of change in technology. Technology is increasing at a very fast rate. So depreciation is nothing but the fall in the value of fixed assets due to normal wear and tear, passage of time, expected obsolescence, and change in technology. Now, while solving numericals, you will find various names used for depreciation like consumption of fixed capital, current replacement cost of fixed capital, capital consumption allowance, etc. So don't get confused, it is nothing but depreciation only, that is given to you in order to check that whether you are clear with the concepts, whether you know various names or not. Okay, it is just to make the question a little trickier. Okay, so if you are aware with all these facts, then it will be very easy for you to solve the questions that will come, right? Now the next concept is circular flow of income. Now what is the circular flow of income? See, firms hire various factors of production from households, right? Householders provide their labor services and other services to firms. In return of that, firms provide um, factor payment to householders, and from that factor payment in the form of wages, income and salary and profit, what they do, they buy various goods and services which are produced by firms. Okay, in this way, in the form of consumption expenditure, the same money reaches back to the firm. In this way, money is continuously flowing from firms to household and then from household to firm in a circular way. Thus it forms circular flow of income. So circular flow of income is nothing but a continuous flow of income between firms and household. So money first flows from firms to household in form of factor payments in return of the services that households provide, and then from households to firms in the form of consumption expenditure that consumers buy the product of the firm. Okay, so in this way the money continues to flow in a circular way and thus forming the circular flow of income. Here you can see in this diagram the producing sector, that is firms, are providing factor payment in the form of rents, wages and salaries, interest and profit to householders, and householders are providing consumption expenditure to firm, and in between is their financial sector, that is banks, etc., in which they are doing savings and are also taking loans from them. Now circular flow can be divided into two parts: real flow or nominal flow. So real flow is nothing but it is a flow of goods and services between firms and households, right? Since it is a flow of goods and services, that is why it is also called physical flow, because physical output is circulated between firms and household. So here you can see in return of households are providing factor services to the firm and firms are providing goods and services to household. So here we are only accounting goods and services, that is only physical output. That's why it is real flow or physical flow, right? Another one is money flow. This is the flow of money between firms and households, right? So here you can see in return of the factor services that households provide, firms are providing factor payment, right? And in return of goods and services, households are providing consumption expenditure, right, to the firms. So here money is transferring between firms and household. That's why it is called money flow. Okay, so it is a flow of monetary transactions and it is also called nominal flow. Now there is one more important concept which is although not there in your syllabus, but in order to make a strong base, you need to learn this concept as well. So this is the concept of leakages and injections. Now, what are these leakages and injections? See, leakage means withdrawal from the flow. Suppose you have a cut in your body, then what will happen as a result of it? Your blood will flow out and you will feel weak. On the other hand, if you have got an injection, then it will increase your immunity, it will add something to you. So in the same way, leakages are the withdrawal and injections are introduction of income to the flow, right? And leakages have negative impact on the process of production because these withdrawals affect the economy in a negative way. For example, it reduces the flow of income and production, it reduces demand of goods and services. On the other hand, injections are good for the economy because they add to the productive capacity of the economy and generates demand for goods and services. The example of leakages are saving, taxation and import, and of examples of injection are investment, exports, consumption, etc. Now this figure summarizes everything. Here you can see the orange one are showing you the nominal flow, and the red one are showing you, and the green one are showing you the real flow. Okay, that how there is flow of goods and services between firms and households, and how there is flow of income between firms and households. So that is all for this video. We will be covering all the technical portion in the videos that will be following this lecture. So please stay tuned and try to solve the questions that are given in the attachment below this video lecture. Okay, and please try to answer all those questions in the comment section so that you can check it out whether you learned all these concepts or not. Thanks for watching.